섹션 1을 시작하겠습니다. 첫 번째 섹션 주제는 OECD 필라2로 불리는 글로벌 최저한세의 쟁점과 다국적 기업의 대응입니다. 발표자 피터 반스, 헤더 샤프로스를 소개하겠습니다. 피터 반스 변호사님은 미국 예일 대학교 로스쿨을 졸업하시고 미국을 대표하는 글로벌 기업인 제너럴 일렉트릭에서 약 22년 동안 국제조세 분야를 담당하셨습니다. 이후 미국 재무부 조세 정책실을 걸쳐 미국 뉴욕과 워싱턴 DC에 기반을 두고 있는 로펌 캐플린 드라이스데일에서 국제조세 업무를 담당하며 고문으로 활동하고 계십니다. 또한 현재 듀크대와 뉴욕대 로스쿨 교수를 겸임하고 있으며 2021년부터 국제조세 규범의 형성을 주도하고 있는 대표적인 국제민간 학술 단체인 국제조세협회 이파의 글로벌 대표를 맡아 활발히 활동을 하고 계십니다. 헤더 샤프로스 변호사님은 미국 프린스턴 대학교에서 공학 박사 학위를 취득하시고 미국 하버드 대학교 로스쿨을 졸업하셨습니다. 피터 반스 변호사님과 함께 로펌 캐플린 드라이스데일의 국제조세 그룹에서 근무하면서 글로벌 기업들에게 국제조세와 이전 가격 관련된 다양하고 깊은 자문을 제공하고 있습니다. 네, 첫 번째 섹션이 영어로 진행되는 점을 감안해서 저희가 먼저 간략하게 한국말로 토론 발표 자료 내용을 갖다가 설명드리도록 하겠습니다. 네. 저희 2024년부터 국내 세법의 글로벌 최저한세 제도에 시행되고 있다는 사실은 여기 계신 참가자들 대부분이 잘 아시라고 생각합니다. 이는 OECD 필라2 합의를 국내에 도입한 것입니다. 첫 번째 섹션에서는 그 OECD 필라2가 과연 무엇인지, 도입된 배경이 무엇인지, 필라2 모델 규정의 구성 및 사례, 주요 국가들의 도입 현황, 향후 예상되는 잠재적인 이슈 및 다국적 기업이 직면하게 될 과제 등을 논의하겠습니다. 필라2 합의는 OECD가 주도하는 다국적 기업의 세원 잠식을 통한 조세 회피 방지 대책, 즉 베프스 프로젝트의 일환으로 디지털 경제에서 조세 문제 해결을 위해 등장했습니다. 전 세계 142개국이 참여하는 회의체의 주도로 지난해 극적으로 글로벌 최저한세 제도에 관한 합의에 도달했습니다. 다국적 기업의 소득에 대해서 특정 국가에서 최저한세율보다 낮은 세율을 적용하는 경우 다른 국가에서 추가 과세권을 부여하는 제도입니다. 이는 디지털 경제에서 현재 국제조세 제도의 한계를 극복하기 위한 방안으로 논의되고 있습니다. 필라2는 연결 매출의 기준 7.5억 유로, 현재 환율에 따르면 우리 돈으로 약 1조 115억 원입니다.를 초과하는 다국적 기업을 대상으로 하고 있고 국가별로 실효세율을 계산하여 그것이 최저한세율 15%에 미달하는 만큼 추가 세액이 부과됩니다. 이를 통해 다국적 기업들이 유효세율 15% 이하인 국가로 소득을 이전하거나 투자할 유인을 낮추는 것이 목적입니다. 필라2는 최종 모회사가 자회사들의 최저한세 해당 미달세액만큼 최종 모회사 소재지국에 납부하는 IIR이라 불리는 소득산입 규칙과 소득산입 규칙이 적용되지 않는 경우 추가 세액을 자회사들에게 배분하는 UTPR이라 불리는 비용 공제 부인 규칙을 주요 골재로 하고 있습니다. 또한 국가별 실효세율을 각국에 소재한 구성 기업의 회계 자료에 일정한 조정을 거쳐서 산정한 글로벌 최저한세 손익과 단기 법인세 비용에서 일정한 조정을 거쳐서 계산한 조정 후 대상 조세를 바탕으로 산출됩니다. 2024년부터 글로벌 최저한세 제도를 시행하기로 한 우리나라는 EU 및 영국 등과 함께 OECD 합의에 따라 선도적으로 필라2를 법제화한 국가 중 하나입니다. 다국적 기업들은 필라2 시행에 대비해서 그룹의 지배구조, 실효세율 산출을 위한 재무정보의 수집 방법, 회계자료에 대한 조정 및 증빙의 구비, 국가 간 또는 과세기간별 수익 인식 시기의 차이 등을 면밀히 검토해야 합니다. 당초 OECD에서 필라토 합의를 주도했던 미국은 지난 중간선거의 결과에 비춰볼 때 오히려 2025년까지 이를 법제하지 못할 가능성이 예상됩니다. 그렇지만 미국의 본사를 둔 다국적 기업들이 개정을 요구할 가능성도 높습니다. 그 이유는 미국의 세원잠식 방지를 위한 길티와 BT와 같은 기존 제도들이 IIR로 취급될 수 없고, 미국에 모회사가 있는 경우에는 UTPR에 따라, 미국의 자회사가 있는 외국 회사의 경우에는 IIR에 따라 타 관할국의 과세권이 넘어갈 수 있으며, 미국의 조세 정책이나 투자 인센티브 정책에도 그 영향을 받을 수밖에 없기 때문입니다. 실무적으로 필라토에 대비해서 ERP 시스템의 조정과 테스트가 이루어져야 합니다. 또한 아직 불확실성이 많은 필라토 규정들의 문헌과 적용 효과를 사전에 분석하고 문서화하여 향후 상호합의 절차 등 국제조세 분쟁 해결 과정에 대비할 필요가 있습니다. 복잡한 국가 간 과세권 조정 과정에서는 이중과세 문제가 발생할 가능성이 높기 때문에 다국적 기업들은 그 위험을 미리 파악하고 스트럭처링과 텍스 플래닝을 효과적으로 준비할 필요가 있습니다. 이상 말씀드린 내용을 토대로 해가지고 1섹션 발표를 생각하고 들어봐 주셨으면 합니다. 그럼 섹션 1 발표를 시작하도록 하겠습니다. Hello, Peter. Thank you for joining. Would you please start?
Thank you very much for the invitation to participate today and for the introduction. For myself, and I know for Heather as well, we're very grateful for this opportunity to talk with you about Pillar 2. I've had the privilege of working on cross-border matters between the U.S. and Korea for more than 30 years, and I'm delighted to be with you today. Pillar 2 is an extremely complex provision, and we will try to deal with it only at a very high level. But I hope what we can do is show you some of the key features of Pillar 2 and also talk about what all of us here today as advisors, as taxpayers need to be thinking about as we move into the new world. It's extremely interesting that Pillar 2 is actually on the verge of enactment. Because it's contrary to more than 300 years of international tax practice. A rule called the revenue rule is a principle more than a rule. The revenue rule prevents one sovereign country from helping another sovereign country collect its taxes. But over the last 20 years, that rule has been swept away, and Pillar 2 is the culmination as countries come together to try to work together and ensure that multinational corporations are paying at least a 15% minimum tax. We'll talk about the details. Pillar 1 may or may not be enacted. I think Pillar 2 will be enacted. And so it's important for all of us to understand what it does and what we need to do to prepare ourselves. Let me turn it over to Heather to get us started substantively. Heather?
Thank you. We'd like to begin by putting Pillar 2 in its historical context. As many of you know, Pillar 2 originated in the base erosion and profit shifting project of the OECD and the G20, also known as the BEPS project. The BEPS project addresses the incentives that companies have to shift profits from jurisdictions with high taxes to jurisdictions with lower taxes or no taxes. The OECD estimates that this profit shifting may lead to between 100 billion and 240 billion in lost tax revenue worldwide each year. Partly in response to the financial crisis of 2008 and 2009, in 2012, the leaders of the G20 asked the OECD to identify weaknesses in the international tax system that create opportunities for base erosion and profit shifting. In October 2015, the OECD released a list of 15 BEPS action items. BEPS Action 1 was the need to address tax challenges posed by the digital economy. BEPS Action 1 has evolved into a two-pillar approach. Pillar 1, addressing a jurisdiction's ability to tax a company's income, even if the company does not have a physical presence there. And Pillar 2, addressing a jurisdiction's ability to place a limit or a floor on the competition among countries for lower corporate tax rates. The OECD G20 Inclusive Framework on BEPS is the group of countries and jurisdictions working on the Pillar 1 and Pillar 2 approach. In October 2021, the Inclusive Framework released a statement describing a two-pillar solution, and as of mid-December 2022, 138 jurisdictions so far had joined the statement. Today, we're going to be talking specifically about Pillar 2, and Peter is going to speak next.
I want to underscore what Heather just said, which is 138 or 140 countries are involved in this exercise. So this really will affect you in almost every jurisdiction where you're active. On its face, Pillar 2 applies to multinational companies with revenues of at least 750 million euros. This threshold may be familiar to you. This is the same threshold that applies for country-by-country reporting, as many countries have adopted it. But I don't want those of you who work for companies with less than $750 million in annual revenue to think that this is irrelevant to your work. There is no reason why a particular country could not apply the concepts of Pillar 2 to its own headquartered companies at thresholds below 750 million. And in fact, that's what the United States has done. So any company in the US that may have operations around the world are affected by our rules that are similar to Pillar 2 without regard to that threshold. If a company is included in the Pillar 2 rules, then the expectation is that it will pay at least 15% tax on all of its income in each jurisdiction in which it operates. This is aimed quite squarely at those countries that have offered tax incentives, including countries that have no income tax, in order to attract investment. There are a lot of those countries, and you're familiar with many of them. I'll talk in a few minutes about Labuan, about Singapore, about Bermuda, countries that today offer multinational companies an opportunity to earn income at well below 15%. The concern was driven initially by Germany. Germany wanted to stop German companies from relocating to Eastern Europe and said, we need to get together as developed countries and ensure that companies will always be taxed at 15% or more. The point is to make sure that companies are relocating or locating new assets because of business reasons and not necessarily for tax reasons. There are, of course, a lot of countries with tax rates above 15%. Indeed, there's still countries with tax rates above 30%. So 15% is a floor. There are many countries with rates above that. And in fact, there are some countries, particularly developing countries, that have argued that the 15% rate in Pillar 2 is too low. But for now, the goal is to ensure that for every company covered by Pillar 2, that's multinationals with revenue of at least 750 million euros, that you will pay a 15% tax on your earnings in each country where you have operations. Heather, let's get into a few more of the details.
So the Pillar 2 tax is a top-up tax. If income has been taxed at a rate lower than 15%, then the Pillar 2 rules are to top up that tax rate by either increasing income or decreasing deductions until that low taxed income is then taxed at a rate of at least 15%. Under Pillar 2, the right to tax income arising in a country initially belongs to the source country. If that source country implements a 15% qualified domestic minimum top-up tax abbreviated as a QDMTT, that's consistent with the GLOBE rules, then a group's income from that country generally would not be taxed further. If the source country does not have a QDMTT, then the Pillar 2 15% minimum tax is implemented through two global base erosion rules known as the GLOBE rules. These two rules are the income inclusion rule and the undertaxed profits rule. The first rule is the income inclusion rule, or the IIR. If a source country does not impose a top-up tax on income earned by an entity in that country, and if a group's income in that country is taxed at a rate below 15%, then the home country of the group's parent can collect the top-up tax through the income inclusion rule. An IIR works by increasing the income of the parent by adding enough of the low tax income to the parent's income that 15% tax is paid on that income. If the home country of the group's parent hasn't implemented an IIR, then the IIR of the home jurisdiction of the next entity below the parent in the ownership chain applies. If no entity in the ownership chain is located in a jurisdiction with an IIR, then a UTPR may apply. Under the UTPR, if low taxed income is not subject to an IIR, then all of the countries in which the group's entities operate that have adopted a UTPR can collect a portion of the top-up tax. A country's share of the top-up tax under the UTPR depends on the amounts of the group's tangible assets that are located in that country and the percentage of the group's employees that are located in that country. Peter next is going to talk about an example of how these rules apply.
Yeah, the rules that Heather just outlined, to be honest, are hideously complex. If all countries adopt a 15% tax, then life is pretty simple. If all countries adopt an income inclusion rule so that they will impose a 15% tax on the companies that are headquartered in that country but have operations around the world, it's difficult, but that rule is operational. The undertaxed profits rule is extraordinarily complex, and all we're going to do here is identify it and hope that it does not apply. With the chart on the next page, let me walk you through the thinking that you might have as a tax advisor to a Korean company. We will assume, and I think this is the right assumption, that Korea will adopt the Pillar 2 rules. This is obviously a very, very simplistic chart, but assume that the Korean company has a subsidiary in Singapore. As all of you know, Singapore has a variety of incentives. It has pioneer incentives. It offers other kinds of benefits for certain investment. It will offer training grants, low-cost capital, low-cost land, a host of different incentives for an investment in Singapore, as long as you have negotiated those investments with the Economic Development Board. If Singapore's tax rate is below 15% because of the incentives, the headline rate is 17, but the incentives may bring it down, then you will have a top-up tax paid in Korea. It is possible that Singapore itself will impose a new tax, but at the moment, let's assume that the top-up tax occurs up at the Korean level. China is an interesting situation. As you know, almost all of your investments in China are probably taxed at 15% or higher, 25%. But the way that the rules are applied is on a consolidated basis for all your operations in China. And of course, many Korean companies will have 5, 10, 15 subsidiaries in China. For reasons that many of you know, it's often advantageous to set up a new company in China if you're in a different location. So you will frequently have many, many subsidiaries in China. Unless China and Korea and the OECD get together, there will be a lot of data collection required because you as a Korean company may have to combine all your operations in China to show that on an overall basis, you are taxed at 15% or higher. Today, you probably do not prepare consolidated returns or consolidated financial statements for your Korean operations. You do a financial statement for each entity separately, but you do not necessarily combine them. Going forward, it may be necessary for you to do a financial statement for the entire operation in China. Malaysia, I'm sure many of you have operations in Labuan. The history of the Labuan operations and Korea and the Malaysia-Korea Treaty are complex. You may or may not have been involved in the past, but in simple terms, a Labuan investment is often taxed at about 3%. If you are taxed at 3% on your Labuan investment in Malaysia, you would be subject to an additional 12 percentage point tax in Korea. But you are likely to have other operations in Malaysia as well. And those other operations could easily be taxed in the mid-20s. So it will be very important for you as an advisor or a taxpayer at a Korean company to make sure you understand what all of the income and all of the taxes paid at all of the Malaysian subsidiaries is, so that you can hopefully minimize any top-up tax on the 3% paid in Labuan. For instance, if you earn some income in Labuan at 3%, but other income in Ipoh or Penang that is subject to tax at 25%, your blended rate may well be high enough to avoid a tax under Pillar 2. The United States base rate is, of course, 21%, but we have a number of provisions such as accelerated depreciation for purchases of equipment or R&D incentives for research and development. So the headline rate of 21% is not necessarily going to be the effective tax rate. In fact, for many U.S. corporations, your effective tax rate is well below 15%, 8%, 10%, 12%, based on your financial income. So the mere headline rate of 21% in the U.S. is not necessarily going to mean that there's no further tax in Korea under the top-up tax. I want to note now, and we'll come back later, to one of the hugely important features of the Pillar 2, and that is that the 15% tax is tested on your financial statement income. It is not tested on your tax accounting income. I'll come back to that later, but that is a new feature in Pillar 2 and a very important feature that adds work for all of us. Heather?
Pillar 2 developments have been occurring at a relatively rapid pace. Recently, as you know, in December 2022, Korea became the first country in the world to pass Pillar 2 legislation. Korea's income inclusion rule and undertaxed profits rule will come into effect on January 1st, 2024. And these rules are very similar to the OECD's model rules for Pillar 2. And they're part of the new Section 5 of the Korean law for the coordination of international tax affairs. Also in December 2022, the European Union's 27 member states unanimously adopted the minimum tax directive regarding Pillar 2. EU member states will have until the end of this year to transpose the directive into their national legislation. With some exceptions, the EU's income inclusion rule will be applicable in EU member states for fiscal years starting on or after December 31st of this year, and the EU's undertax profits rule will apply for fiscal years starting on or after December 31st, 2024. Similarly, in November 2022, the United Kingdom's Chancellor of the Exchequer confirmed that he would implement Pillar 2 rules for accounting periods beginning on or after December 31st, 2023. Many other jurisdictions have taken official actions to implement Pillar 2 through proposed legislation, or providing specific target dates for enactment, or holding consultations about the rules. For example, Hong Kong has said that it would implement an income inclusion rule beginning in 2024, and Japan has included an outline of Pillar 2 legislation in its 2023 tax reform package, which is expected to become effective in 2024. Peter's going to talk next.
Yeah, before you change the page, Heather, I want to make a not very bold prediction, which is that Korea will not actually implement its UTPR effective January 1, 2024. I look forward to talking with all of you a year from now and see whether that date gets pushed out. As we said earlier, the UTPR element of this rule is extremely complex. And I just am very skeptical that the rules will be sufficiently developed during 2023 and that there will be enough agreement across the globe for Korea to adopt that rule effective January 1, 2024. But that is not a reason for us to lay off and be slack with respect to preparation for Pillar 2. On the next page, I want to talk about what do we as tax advisors and as taxpayers need to be doing right now. But before I jump into this page, let me just take a note. This provision does not eliminate all of the tax treaties that exist between Korea and other countries, between the US and other countries. As many of you know, there are well over 3,000 bilateral tax treaties around the world right now. And one of the interesting questions will be, as we implement Pillar 2, if we go beyond the top-up taxes and we do try to put in the penalty provisions of the UTPR, what does that mean for tax treaties? So I do want you to keep an eye out during the coming year for how countries, Korea and other countries, address the interaction of Pillar 2 and tax treaties. The big issue right now is information gathering. It is going to be required for all companies subject to Pillar 2. And again, this is companies that have 750 million euros or more of revenue, to prepare an information return. The OECD has hinted at what will be required, but the information return is still very much in development. But it is worthwhile, I think, for advisors and taxpayers to be looking at the guidance that has already come out and asking themselves whether, as a company, they are able to put together the information that is required for this globe return. In the first instance, it's information about the multinational group, about its corporate structure, about its ownership. And let me flag for you joint ventures and companies that are not 100% owned by the parent. There are rules about control, about joint ventures. Those rules may or may not change in the coming year. But you're going to need to know an awful lot about the multinational group. And I'm particularly interested in how these rules will apply to, for instance, the chaebols. The Korean chaebols, which you are more familiar with than I am, show interlinking relationships and what information may or may not need to be provided with respect to the chaebols, or similar structures in Japan, the Keiretsus, or other countries where there is a common ownership. And then you're going to need to be looking at how you do the effective tax rate and the top-up tax computations, including, as I mentioned earlier, countrywide effective tax rates. It is very simplistic to think that multinationals have only 1 or 2 or 3 subsidiaries in a jurisdiction. As I mentioned, as you know, your taxpayers probably have literally a dozen subsidiaries in China, but there are other countries where that's the case as well. And you will need to think about whether you have adequate financial data to put together an overall consolidated calculation of the effective tax rate in that jurisdiction. The rules are not fully settled. So although I think it is important to begin to do that analysis now, I'm keenly aware that during the rest of 2023, you may find new rules coming out that require you to go back to your taxpayers, to your clients, and see whether you have the information that you need. The use of financial accounting. We could talk about this issue all day. As you know, the purposes of financial accounting and the purposes of tax accounting are not the same. Moreover, financial accounting under IFRS is not the same in every country. So if you prepare IFRS accounts for Australia or IFRS accounts for China, those may differ from the IFRS accounts required in Korea. And we are still trying to learn what adjustments and what tracking requirements will be required. There will be some timing differences and some other adjustments to your financial accounts. One of the most important adjustments for US companies relates to stock-based compensation. And it will be a very high stakes game as taxpayers push to get certain items adjusted from their financial accounts in doing the calculation for the 15% tax. That game is probably not going to ever end, because even once the rules come out during the balance of 2023, there will be further adjustments to financial statements that taxpayers believe would be appropriate in making before you do the 15% calculations. One other issue that is out there, and I'll talk more about it in just a minute, is the question of audits. Do you have the financial statement material that you need from your accounting firm, and are you ready for all of this information to be audited? I'll talk about that in a little bit more detail in a minute. Let me turn it back to Heather for one of the biggest issues pending out there, which is, what does the US do?
As more countries adopt the Pillar 2 rules, large multinational enterprises will be interacting with the rules. But Pillar 2 was designed so that not every country has to adopt it. Any country not participating in Pillar 2 likely will, to some extent, be subsidizing other countries, because revenue that the non-participating country might be able to collect through an income inclusion rule or eventually an undertax profits rule instead may be paid to other countries. The question of whether the US will conform its tax laws to Pillar 2 is an interesting one. On the one hand, many believe that US tax legislation may be unlikely in the current session of Congress, which means that US tax legislation may be unlikely before 2025. Also in 2025 and 2026, many tax cuts are set to expire and tax rates are set to increase for the US base erosion and anti-abuse tax, BEAT. and with guilty. So that's another reason that tax legislation may occur in 2025. On the other hand, as more countries adopt the Pillar 2 rules, US parented multinational companies may feel pressure and may attempt to persuade Congress to conform the US tax system to Pillar 2. A key question is, why does it matter if the US doesn't conform to Pillar 2? As explained in OECD guidance released last week, the US tax on global intangible low taxed income, or GILTI, will not be considered an income inclusion rule under Pillar 2. Instead, GILTI will be treated as a blended, controlled foreign corporation tax for Pillar 2 purposes. It's a little bit ironic because GILTI inspired the IIR. This treatment will apply for 2024 and 2025, but it'll be reevaluated at the end of 2025 when the GILTI tax rate is scheduled to increase. In addition, if the US does not have an appropriate income inclusion rule in place, an undertaxed profits rule could be imposed on a foreign subsidiary of a US parented group by the country where the subsidiary is located. Similarly, domestic US investments by a foreign parented M&E group could be subject to taxes in the foreign parent's country through that country's income inclusion rule. In addition, Pillar 2 may impact domestic US tax policy and incentives. For example, groups, as we were discussing earlier, might be considered to have low taxed US income under Pillar 2 due to US tax incentives, like the research and experimentation credit. Some had suggested that such credits should be made refundable so that they don't lower a company's effective tax rate under Pillar 2. US discussions of clarifying the regulations about how the US tax system will interact with Pillar 2 really just began in September of last year. So it could be some time before we see those regulations. So if the US doesn't conform to Pillar 2, I think we're all waiting to see what's going to happen. Now I'll turn it back over to Peter to discuss.
Yeah, in this group, I'm tempted to say that the Pillar 2 is a Jobs Act for tax lawyers and tax professionals. There's an enormous amount of work that needs to be done by all taxpayers, and we are the ones who will be leading that exercise. That doesn't necessarily make me happy, though, because I do see the complexity of this, and it worries me a little bit that the rule is so complex, it'll be extremely difficult for taxpayers to comply even when they want to. Heather, if you'll flip to the next page, I think the steps we need to be taking as tax professionals are really as follows. First, we need to make sure that our clients, which may be ourselves if we work in-house, or our clients if we work in advisory firms, that our clients understand the data collection that will be required and that their ERP systems are going to collect that information. The one thing that we're discovering quickly is that if your accounting system does not collect the data as you go along, it's impossible to collect it with hindsight. That means for the January 1, 2024 effective date of Pillar 2, you need to be sure that the accounting system is fixed this year, 2023, so that it is collecting the necessary data from the beginning of 2024. In addition, there are certainly a number of rules still in development, and in particular, sector rules for particular industries. I would encourage those of you in financial services to work with the other financial services companies to make sure you understand the rules. And if there are elements of rules that don't work for you, speak up and be involved. Same for heavy manufacturing, same for retail, same for any industry. There may be special elements of your industry that need to be addressed as you go forward. And the OECD is extremely receptive to comments. I would also urge you to work with the Korean government. We are all worried that as 140 countries consider Pillar 2's rules, that some countries will take a different approach to one element of the rules or another element of the rules. If you have a client, a major multinational in Korea that operates in 20 countries, this will be difficult enough if you have to apply Pillar 2 to all 20 countries and the rules are the same. If some of the countries have different rules, it will become magnitudes more difficult. So work with the government to be sure that the government changes as few rules as possible. Let me talk about incentives for a minute, and Heather made a very important point. The OECD is trying to give guidance on when incentives will not affect your 15% tax rate calculation and when it will. I suspect what will happen is that both taxpayers and governments will need to adjust their policies with respect to incentives so that governments do not give tax incentives that are immediately eliminated through the top-up tax of another country. That would be foolish for governments to give up their revenue if the taxpayer immediately pays the same amount to another government. And I also want to talk about audits, both audits in making sure you're getting the right data up front, but also tax audits on the back end. One of the big questions is whether a Korean multinational, for instance, prepares its Globe report, it prepares its various returns. Who's going to audit that? Will that be audited by the Korean government, or will every government in the world want to reach in and consider Samsung or Hyundai or any other major multinational in Korea and look at those tax returns? Although we don't really know how it's going to unfold in practice, what I think we must do is be ready as tax advisors to have good advisors in all of the countries where there are major operations who are familiar with our businesses and ready to be proactive and supportive as audits may arise. As you know, because Korea has this issue in spades, you may get a call from a tax official on Wednesday that they will be there to look at your books and records the following Monday. In that situation, you don't want to be scrambling to find the right tax advisor. So as disputes arise under Pillar 2, I urge you to identify in advance strong advisors who know your company and who can be supportive in all the major countries around the world where you will be filing returns and where you will be subject to Pillar 2. Let me pause there. Thank you very much. This is only an appetizer, not the full course on Pillar 2. But let me stop there and ask in particular whether our panelists have any questions or issues that we should address.
Okay, Peter and Heather, thank you for your kind speaking. Let me move to next steps. 자, 이제 토론을 시작하도록 하겠습니다. 토론은 영어로 시작됩니다. 잘 이해하실 수 있도록 국어 토론문을 화면에 업로드하겠습니다. 첫 번째 토론은 신상현 회계사님이 진행해 주십니다. 신상현 회계사님은 삼정회계법인, 안진회계법인 이전가격팀에서 다양한 거래에 대한 이전가격 실무를 쌓은 우리나라 이전가격 분야 최고의 전문가입니다. 현재는 국제조세협회 YIN 한국지부 감사도 맡고 계십니다. 신상현 회계사님 시작 부탁드리겠습니다.
Thank you for sharing your insight on Pillar 2, which has become an essential issue in the field of international tax recently. With the introduction of global minimum tax, there is an increasing need to revisit the various tax incentives that multinational companies receive from overseas investment. In this regard, the OECD emphasized the changes in tax benefit in each country and recommended reviewing the current system in the recent report. The following summarizes the expected issues related to future changes in tax incentives as mentioned in the report. First, companies excluded from Pillar 2 by having their consolidated sales not exceeding 750 million euro threshold are expected to keep their current tax benefit. Therefore, one of the options that may be operated by the host country is a binary tax incentive system that distinguishes companies subject to Pillar 2 from those not exceeding the threshold. Additionally, it is expected that multinational companies may alternatively request tax incentives for items such as indirect tax that are excluded from covered tax under Pillar 2 when negotiating with the host company for potential investment. Furthermore, host countries should enhance the efficacy of tax incentive system by implementing tax incentives based on expenses tied to substance-based income exclusion. In addition, companies in countries that have implemented a qualified refundable tax credit system may actively consider taking advantage of the system. Finally, it is expected that the introduction of Pillar 2 will increase the importance of establishment and implementation of transfer pricing policy for multinational companies. Multinational companies can manipulate the profit and losses of their overseas subsidiaries through related party transactions. So if constituent companies are subject to taxations, post-filing adjustment and recalculation of effective tax rate become inevitable, resulting in an increase of compliance costs from the company's perspectives. So in this regard, I would like to respectfully ask the speaker to share their perspectives on forthcoming changes in tax incentives policy and future transfer pricing challenges that multinational companies may face after the implementation of the global minimum tax. 다음으로 피터와 헤더로부터 1세션 토론문에 대한 답변을 듣도록 하겠습니다. Peter and Heather, please go ahead.
These are wonderful questions. Let me try to answer briefly because we could spend hours on them. I think there will be a change in the way countries try to entice new investment. You mentioned correctly that companies under 750 million euros are not affected directly by Pillar 2, so they could retain all sorts of tax incentives. I don't think that's what's going to happen because that creates a cliff effect. As a company begins to grow and begins to expand, all of a sudden it hits 800 million euros, and then it's in a dilemma. I think what will happen is that more countries will move towards the Singapore approach, which is to offer a host of different kinds of incentives that are negotiated one-on-one between the taxpayers and the governments. Training grants, low-cost land, perhaps some subsidized R&D, perhaps indirect taxes, reductions in various social payments that may be required by a company, at least for a period of years. To me, that is a safer way for both governments and the taxpayers to respond. We will see it's very intensive for the government and the taxpayers to have these negotiations, but I think that's where many countries may go. Your comments on transfer pricing are very important because transfer pricing adjustments may go back 2, 3, 4, 5 years. It will create a lot of complexity if there's a transfer pricing adjustment, and that then affects the Pillar 2 calculation that was made in prior years. So I certainly think taxpayers are already incentivized to have good transfer pricing policies, good transfer pricing documentation, but this set of Pillar 2 rules makes that ever more important. I also want to emphasize that I think some governments have a misunderstanding of transfer pricing audits. Some governments believe if they do a transfer pricing audit and don't make an adjustment, then that's a failed audit. It's not. That's a successful audit because it means the transfer pricing was appropriate when the taxpayer did the transactions and filed the return. So I hope that governments and taxpayers work together to be sure their transfer pricing is both clear and appropriate, and we reduce the number of adjustments going forward. But you're right, very right, to identify that transfer pricing remains quite important in a Pillar 2 world. Heather, you may have ideas to add.
I agree with everything that you said. I just had a little bit to add to your first point that many methods of implementing domestic tax policy that exist now and are in use now can be used that don't interfere with Pillar 2, such as grants, refundable tax credits, accelerated depreciation. And I agree that things are going to move farther in that direction.
Thank you, Peter and Heather, for your comments. 피터와 헤더의 답변을 매우 간략하게 요약하여 설명드리도록 하겠습니다. 먼저 텍스 인센티브와 관련해서 비조세적 지원 혜택의 중요성을 더욱더 강조하고 있습니다. 따라서 토론문에서 언급한 텍스 인센티브의 변화뿐만 아니라 로코스트 캐피털이나 로코스트 랜드 등 비조세적 지원 혜택이 더 늘어날 것으로 예상하고 있습니다. 그리고 결국 이제 텍스 인센티브가 내포되어 있는 한계를 지적하면서 텍스 인센티브보다는 비조세적 지원 혜택이 더욱 가치 있을 것으로 바라보고 있습니다. 그리고 두 번째, 이전 가격 관리의 중요성과 관련해서 필라2 역시 정상 가격 원칙에 따라 거래를 수행해야 함을 규정하고 있고, 과세가 발생하는 경우 신고 조정 및 실효세율 재계산 등이 필요하게 돼서 기업 입장에 납세 협력 부담이 증가하기 때문에 이를 위한 관리의 중요성이 더욱더 강화될 수 있다고 판단하고 있고요. 마지막으로 이제 피터 변호사님께서 말씀하셨던 내용 중에서 과세 당국 자체들이 이제 이전 가격 그 어딧을 했을 때 이게 조정 금액이 발생하지 않은 경우에서는 실패한 오딧이라고 생각하는 경우가 있는데, 근데 그거는 이제 실패한 오딧이 아니라 정상적으로 이제 그 이전 가격 관리가 잘 된 것이기 때문에 그 과세 당국의 관점의 변화가 필요함을 마지막으로 언급하셨습니다.
네, 신영 회사님 토론 감사합니다. 그 섹션 1 두 번째 토론은 박영웅 변호사님이 담당을 해주십니다. 박영웅 변호사님은 3일 회계법인 국제조세팀에서 공인 회계사로서 경력을 쌓은 후 현재는 우리나라 법무법인 화우에서 국제조세팀을 이끌고 있는 회계사 변호사 자격을 모두 갖춘 우리나라의 젊은 국제조세 전문가입니다. 네, 박 변호사님 부탁드립니다.
Peter and Heather, thank you for your valuable information. You briefly mentioned in your presentation, but I'd like to clear a part, to ask a question about a part of what I want to clarify. Despite the fundamental agreement on implementation of Pillar 2, there are differences in the timing and method of integrating the regime in domestic legislation in each country. For example, in the EU or the UK, it is announced that legislation of Pillar 2 will take effect from 2024, and the UTPR is scheduled to be implemented 1 year later than the IIR, while in Korea, both will be implemented together from 2024. Under the UTPR, the constituent entities in other jurisdictions may be taxed regardless of source of income, provided that the ultimate parent entity has not introduced an IIR or is taxed at a lower effective tax rate of less than 15%, it may conflict with the fundamental principle of allocating taxing rights on tax treaties of each country, and this problem may be exacerbated when a few jurisdictions implement Pillar 2. If you have any comment from the legal perspective related to challenges to the traditional international tax system, please let us know. In addition, I anticipate a number of international tax disputes will arise in the early stages of the implementation due to the difference of national global minimum tax system. However, the existing mutual agreement procedure alone may not be effective and sufficient in resolving diverse disputes, so the need to create an independent multilateral treaty is being discussed. In this regard, OECD had received commands for a detailed resolution of international tax disputes, such as the dispute settlement procedure named Tax Certainty of the Globe Rules by February 3rd. We understand that not many days have passed since the reception of the commands. If you know any of the received comments are useful to us, please let us know.
Thank you. Let me offer quick answers. I have tremendous concern about the UTPR, and I think it will not be possible for that to be implemented in 2024 in Korea or any other country, and I have doubts it will be implemented in 2025. And that's okay, because if countries enact a 15% minimum tax themselves, or if they enact a top-up tax, then the goals of Pillar 2 are achieved without the need for the UTPR. Let me take a simple example. Let's say the US is not compliant and Korea seeks to apply the UTPR to a US company. That is simply going to violate the US-Korean treaty, and you are going to have one long dispute. So I think the UTPR is important. I know my friends at the OECD think it's manageable. I don't. And so I think that's off in the future. That feeds to your second question, which is dispute resolution. I was reading comments over the weekend. I think the biggest set of comments is simply saying we need to go beyond bilateral maps to multilateral mutual agreement, because particularly with respect to the UTPR, you are likely to have a taxpayer's affairs affected by 3, 4, 5, 10 countries. And we do not today have a multilateral dispute resolution mechanism that works. It's a dream. I've dreamed it for 20 years. I've talked about it with OECD friends and others, but I think finally under Pillar 2, we're going to have to get a multilateral dispute resolution mechanism so that a taxpayer can come forward and say, if you all don't like what I've done, that's fine, but I only have $1 million here. You figure out who gets what. And several of the comments so far to the OECD have emphasized the need for a multilateral dispute mechanism. Heather?
I wanted to mention that as an alternative to the MAP process, the OECD has suggested using a program similar to ICAP, the International Compliance Assurance Program that's used now for some transfer pricing. ICAP is a voluntary, application-only, cooperative risk assessment and assurance program for multinational entities in certain jurisdictions. Typically, it's completed within 6 months, and it provides multilateral consensus on multinational groups transfer pricing and international tax structure. The OECD envisions an ICAP-like program as potentially providing consensus about the GLOBE information return and the calculation of the top-up tax. Although this may work for groups that operate within a limited number of countries, it could be more difficult to implement something like an ICAP program if your MNE group operates in a very large number of countries. But that's another alternative that's being considered.
Right.
예,
And go ahead.
발표자의 답변을 간략하게 정리해서 말씀을 드리면 2024년 한국의 개정세법에 포함된 소득산입 보완 규칙이 제대로 시행될 수 있을까 의문이라고 합니다. 이는 이제 소득의 원천에 따른 이중과세를 조정하는 현재 조세 조약 구조와의 충돌이 불가피하기 때문인데 2024년까지 발표 때도 말씀해 주신 것처럼 국제사회가 그 조약을 수정하거나 새로운 조약을 만들리라 생각되지는 않기 때문입니다. 필라 2가 더 많은 국제 조세 분쟁을 일으킬 것으로 예상이 되기는 하지만 본질적으로 각국에서 서로 다른 관할 국가의 그런 제도를 얼마나 존중할지 여부가 더 관심이 쏠리는 부분이라고 지적을 하셨고 OECD에서 커멘트를 접수받은 부분에 대해서는 쌍방 그 맵이라고 불리는 쌍방 상호 합의 그 제도가 더 중요하게 지금 논의가 되고 있다는 점을 부연해 주셨습니다. Peter and Heather, thank you for the kind opinion.
Thank you very much. We've appreciated this opportunity and wish you all success in the next session.
Thank you. Thank you again.
Thank you.
Thank you.
And we look forward to you again soon. Bye bye.
Thank you so much.
Yeah.
Bye-bye.
Bye-bye.
네, 다시 여기 돌아와서요. 저희 이번 세미나가 웨비나로 진행되고 있는데 지금 피터하고 헤더가 미국 동부 쪽에 계십니다. 그래서 지금 미국 동부 시간이 현지 시간으로 월요일 새벽 지금 1시여가지고 너무 늦은 시간이어서 저희 좀 토론을 하는데 좀 한계가 있어서 토론하지 못한 점 좀 양해 부탁드리겠습니다. 그 대신 그 궁금한 사항 있으시면은 저희에게 이메일로 보내주시면 저희가 성의껏 답변 드리도록 하겠습니다. 네, 그럼 첫 번째 세션 마무리를 여기서 짓고요. 한 1분 정도 좀 잠깐 쉬었다가 다음 이 세션 시작하도록 하겠습니다. 좀 이따 뵙겠습니다.